Hello, everyone. Welcome again to this accounting studio. And today we're just going to take a look at accounting, the standard called IAS 8, International Accounting Standard number 8, called accounting policies. As you see here, accounting policies. But also we'll take a look at changes in accounting estimates. And lastly, we'll take a look at errors. So this standard is mainly concerned with three matters: accounting policies, estimates, as well as errors. Now, we'll go in turn to check at everything that we're just trying to talk about here. All right. So actually, for those who will be missing this one, actually, I'll upload it to this YouTube channel. You can just go to this YouTube channel and check out what you can get. Now, let's just go to introduction. First of all, what is the main aim of this standard? The main aim of this standard is, let's say, when speaking of errors, we speak of prior period errors. Let's say this is 2022. You are preparing financial statements for 2020, or let's say you're preparing financial statements for 2021, but you discover that a lot of errors were made in the previous periods. Now, to provide for such errors, you need to apply this standard here on prior period errors. But also, let's say that you are charging depreciation using the straight line method. I hope you know the depreciation methods. You are using the straight line method to charge depreciation, but later it came and happened that the pattern of use changed, and the change of such pattern led you to use now the reducing balance instead of the straight line. So you change the depreciation method. Now, change of that depreciation method, or let's say change of the useful life, this would constitute the change in accounting estimate. So that's the meaning of change in accounting estimates. But also we have changes in accounting policies. Actually, any change that occurs due to in measurement basis of the asset, let's say, in presentation, or let's say in recognition, that would constitute changes in accounting policies. So let's just put them in summary here in a very, very summarized format before proceeding to go deeper, because I know that your also main concern is how to tackle questions. It's just like this. The standard speaks of three things. We have accounting policies. This is number one. But also we have prior period errors. When speaking of prior period errors, we speak of errors in the previous period. So if now we are in 2020 and we have the statement of 2020, we have no issue about this year. If there is an error in this year, we'll just correct it in a normal way. But if there are errors in the previous periods, we'll have actually to follow the procedures. Now, the simple matter to know here is when speaking of accounting policies and the prior period errors, in case you need to make an adjustment, we usually say that we make a retrospective adjustment. So we make a retrospective adjustment. That is, if you made an error, maybe in an error occurred 2 years ago, you will have to go back to such years and then come back to this time to see the effect on the financial statement of financial position. The same applies to accounting policies. If accounting policies change, let's say you are valuing your inventory using FIFO method, but now you are valuing your inventory using weighted average method. You'll have to go back as much as you can, as long as it is practicable. So that's what we do. But also now, apart from policies and the prior period errors, we have accounting estimates. So when speaking of accounting estimates, we do not make a retrospective adjustment. We say that we make a prospective adjustment. These are very, very important matters. So this is a summary of everything that we will be going through in this standard. By prospective adjustment, we mean that we start making adjustments only for the previous period. For example, you are charging depreciation in the previous year and using a useful life of 10 years. But now the useful life of the asset has changed from 10 years, let's say, to 15 years. you know, if the useful life changes and you are using the straight line method, you would have to recompute your depreciation. Now, this effect of depreciation will start from this year. We assume that the previous years were just fine, unless we are told that there was an error. If it wasn't an error, we say that no, in the previous period it was fine. In this period, the useful life has increased, maybe because we have improved the asset, maybe we have changed maybe we have changed the engine of the car or engine of the machine, such that the machine now has a much longer useful life. So that's what we do here. So let's proceed now. We'll just go through it faster and then we'll go to questions. We'll have to solve about 2 questions on accounting policies, on estimates, but as well as on accounting policies, I mean, on estimates, as well as on errors. The questions are very simple. So let's proceed here now. So as I just told you, IAS 8 is applied in selecting and applying accounting policies. You know, accounting policies the company has to select and apply them, but also accounting for changes in estimates and reflecting correction of prior period errors. So as I told you, we speak of 3 matters here: selection and applying accounting policies. And then we speak of accounting for changes in accounting estimates. And lastly, we speak of how to correct the prior period errors. This is all that the standard is entitled to, is expected to help you in. So just like this. So as I said, the standard requires compliance with specific IFRS in applying to a transaction, event, or condition, and they provide guidance on developing accounting policies. So if you're just a company, maybe if you're an accountant with a company, or maybe the member of the board of directors of the company, and you need an accounting policy and you have no idea, you can consult this standard to understand that. Now listen here, as I told you, the standard requires compliance with any specific IFRS applying to a transaction, event, or condition, and they provide guidance on developing accounting policies. As I told you, you need to develop an accounting policy, you come to this standard. This standard is very practicable even in governmental affairs. So as long you can just develop accounting standard that will result in relevant and reliable information. Actually, I'm just going to see soon. I say be careful, be very careful when I'm speaking of this. In an exam, it's not necessarily just be asked on how to compute a question. You'll be asked of giving explanations on this. So be very attentive. All right, as I told you earlier, as I told you in the summary, changes in accounting policies and the correction of errors are generally retrospectively accounted for. Look at this, retrospective accounting. We account for them retrospectively. So as long as it is policies or correction of errors, which are prior period errors, you apply them retrospectively. Retrospective, that means you go back as much as you can. Even if an error occurred 5 years ago, you have to go back and try to check the impact of it up to the start of this period. So not very right here. That's why I just made a summary there. I hope you are there. So you make a retrospective accounting. Whereas changes in accounting estimates, now look, as I told you, changes in accounting estimates, you account for them prospectively. I hope you know this now. So first of all, before going any further, you have to understand that we have accounting policies, prior period errors, and accounting estimates. I'm repeating again. Let me just repeat again here, because if you are just studying for the first time, it could confuse you really. So as I just told you, we have 3 matters. First of all, we have accounting policies like this. For accounting policies and the prior period errors, we apply them retrospectively. That means we go back. But for accounting estimate, this is the summary of the standard. You have to understand this. Actually, for accounting estimates, we apply them prospectively. Just start from this period going in the future. By saying prospectively, that means of the current, just current and the future periods. We just consider current and the future periods. This is a very, very important point. Even if you are asked an exam to give explanations, we'll just speak it that way. But when speaking of retrospectively, for policies and errors, we apply them retrospectively. So you consider the past, present. Actually, it will be the past and the present, actually. Past and present. It's now, when speaking of policies, we also say present, but actually when speaking of errors actually, since these are prior period errors, we just consider previous periods. The current period is very much obvious. You just have to consider it. So let's proceed so that we reach an example. Just go to an example and solve everything. I think we're just fine here. All right, let's proceed now. So, as I told you, IF8 governs the following topics. I spoke of selection of accounting policies, as well as changes in accounting estimates, as well as prior period errors. I think I've spoke about this a lot of time now. It's no longer a new thing to you. I hope that. Oh, sorry. So we proceed now. Now we start with accounting policies, and then we proceed further. What do we do about accounting policies? No, don't worry. For accounting policy, I'll just be going and then after this, we'll go to an example. So we are told that accounting policies, don't worry, you just understand each and everything. By accounting policies, we are just told that these are the specific principles, maybe bases, maybe conventions, anything, rules and practices applied by an entity in preparing and presenting financial statements. How do you prepare and present your financial statements? How do you prepare and present your? You have to mute yourself. Otherwise, I'll just have to remove you. If you don't mute yourself, then make sure that you are in the place that is good, that has got no noise. It shouldn't be like 2 days ago. So these are just accounting policies. The company needs to account for something, but they do not know how to do that. So they establish the principle. The good example of changes in accounting policies, a nice example of changes in accounting policy would be the change in the measurement basis. Let's say inventory. I think you have read about IS2, International Accounting Standard number 2, inventories. Inventory allows FIFO allows to measure its cost using FIFO or AVICO. In case you are using FIFO and then you change it to AVICO, you have to go back to make a retrospective adjustment from the previous periods. So that's what we do here. All right, actually we'll see all examples, so do not worry at all. We're just going to see everything. So IF8 requires an entity to select and apply appropriate accounting policies complying with IFRS and interpretations to ensure that financial statements provide relevant information. That is, so simply speaking, when an entity establishes its accounting policies, they have to make sure that they are complying with IFRS or their interpretations. You know, some IFRS, they are complicated, so some interpretations are usually established, so it is just like that. So you have to comply so as to provide information that is relevant, but also to provide information that is reliable, just like this. By saying relevant, we speak of information that is relevant to the economic decision-making needs of users. Financial statements are used by other people too, so it should be relevant to their decision making. But also it should give information that is reliable. By saying reliable information, we mean that first of all, there should be faithful representation. Information should present faithfully the statement of financial position, financial performance, as well as the statement of cash flows of the entity. So faithful representation, but also by saying that information is reliable, it should reflect economic substance. Have you ever heard of something called substance over form? Substance over form, that is, you should present economic reality rather than just legal form. Actually, all these matters are incorporated into the conceptual framework. So just like this, You present the economic substance of the entity rather than just the legal form. But also they should be neutral, that is free from bias. Should incorporate prudence. You know, prudence is just exercise of caution, not to go wrong. And also it should give complete information in all material respects. Now let's just go here to policies, give a bit of explanation, and then I will soon go to examples. Just be patient a bit. So let's go to changes in accounting policies. When do we say that you have changed the accounting policy? We'll just see from here. I'll just see a very nice example. Be ready to listen here. But also this point here, in an exam, even in the exam you're just going to do, you could be asked about changing accounting policy. You don't just change accounting policy because you just wish. No, there are principles to follow. So the general rule is that the accounting policies are normally unchanged. Generally, we do not change accounting policy from one period to another. We do not change them so as to ensure comparability. Generally, so as we say, generally, accounting policies remain unchanged from period to period so as to ensure comparability of financial statements. But actually, it could happen that there could arise a situation that they would have to change. Which situation? In case it is required by the standard requires you to change the accounting policy, you would have to comply. But also, if the change results in the financial statements providing a reliable and more relevant information. So if the change would give reliable and more relevant information, you would have to change. You could be asked these things in an exam, so you have to be careful. Actually, we're speaking about this, giving reliable and relevant information here. We spoke them here. Relevant, reliable information. So I hope everything is fine. Now, let's just go to how questions could be asked in an exam. In an exam, you will face something like this. A change in accounting policy occurs if there has been a change in any of the following, in at least any of the following. Recognition. If there is a change in recognition, that we call a change in accounting policy. Change in recognition, what do we mean? You know, let's take a good example of borrowing cost. I don't know if you have read about that or not. Borrowing cost. When speaking of borrowing cost, what do we mean of a borrowing cost? By speaking of borrowing cost, you know, that is called International Accounting Standard number 23. Let me just explain it here. Let's say you had something that we are expensing it, but now you are just capitalizing it. That's why you say an expense is now recognized rather than an asset. Let's take an example here. You know, in the statement of financial position, debit entries are on assets, right? In the statement of profit or loss, debit entries are on expenses. I hope you get this one. This is in statement of profit or loss, while this is in the statement of financial position. Now, since in the statement of financial position it is this way, presume that initially you are recognizing something as an asset in the statement of financial position. Let's say you are recognizing it at 20 million, but now you are told that, oh, this item is no longer an asset, it cannot be capitalized. So you should be expensing it here as 20 million. You have made a significant change. You have moved from the statement of financial position up to the statement of profit or loss, changing completely everything about the asset. From the asset to an expense, or let's say from one expense to the asset. There is a good example of IAS 23 that is called borrowing cost. Borrowing cost. You know, when speaking of borrowing cost, normal cost of borrowing like interest are normally expensed, but it could arise that you capitalize it. You say that, oh, I've incurred an interest of 10 million and you have expensed it. But it could arise a situation that you move from expensing it to capitalizing it, you're taking it to an asset. So it's just like that. So this is recognition. But also, in case there is a change in presentation, you will also have to come this way. This is presentation. Presentation. Change in presentation is, let's say you are an income statement, depreciation, you are usually charging depreciation, you are usually including depreciation and the cost of sales. But now you have changed the line item. Depreciation is now charged to administration expenses. This is a change that means a change in presentation, and so we say in changing on your accounting policies. So when you do this, you cannot compare results of this period to the previous period. Why? Because the previous period would have a much higher cost of sales because depreciation will be in there, but the current period would have depreciation in administrative expenses. So you would be getting a wrong picture. And lastly, we have measurement. Let's say you have changed the measurement basis. Now, by changing the measurement basis, I just gave you an example. Let's say we are just trying to find out ways to measure assets or liabilities. Of course, a good example is measuring assets. Let's say you are non-current assets, and we say that stating assets at a replacement cost rather than historical cost. Changing the measurement base, my assets now will be measured at replacement cost rather than historical cost. This is an example. But another example here would be to change the measurement of let's say inventory. You have inventory here and you change the measurement. Let's say you change the measurement from FIFO just like this. You are using FIFO, but now you're just using AVCO to measure your inventory. So that's what we're just going to do, right? All right, so this was about accounting policies. I think soon we could just go to, we're just completing here, accounting policies, then we'll go to estimates, errors, and then we'll just go to an example. First of all, let's just finish accounting policy and go to an example. Accounting policies here. Now let's take a look at how to account. So an accounting policy has changed. What do you do? As I told you initially, when an accounting policy changes, you have to account for it retrospectively. We just spoke of this very, very early. We make a retrospective adjustment just like this. So the required accounting treatment is that the change should be applied retrospectively. If the change occurred 2 years, maybe the change has occurred now, but actually you just go back as much as you can. If you can go back 5 years, 6 years, 7 years, you just go back there and make adjustments. I think I told you, I gave you the summary of this standard. We are just now applying it. So the change should be applied retrospectively with the adjustment to the opening balance of retained earnings in the statement of changes in equity. Now, this is the main point, my friend. You be very careful here. This is the main point. What you do, you make an adjustment and come to learn at how the opening balance of retained earnings should be. In this, retained earnings is part of equity. So you go to the statement of changes in equity and you compute the opening balance of retained earnings. You usually have to figure that out. This is the main first point in an exam, but also you're told here, comparative information should be restated unless it is impracticable to do so. Let me tell you one thing. When preparing financial statements, you would normally do this. When preparing financial statement, let's say you're preparing financial statement for the year 2021. We usually prepare financial statements also. We usually prepare the set for the previous period, that is 2020. So if you have adjusted 2021, you would also have to adjust 2020. Otherwise, there would be no comparability. You will be having statements of 2 years that would mislead the user of the financial statements. So you have to spot that out. All right, proceeding further, we are told here that if the adjustment to the opening retained earnings cannot be reasonably determined, let's say, you need to know the adjustment to the opening balance of retained earnings under the statement of changes in equity, but you cannot spot that. What should you do? We say that the change should be adjusted prospectively. You got no way, you cannot go far back and apply that change in accounting policy. So if you cannot, you just stay, don't do anything, just apply prospectively. Just start from this period to the next period. But this is if you cannot do that. That's why you say it is included in the current period statement of profit or loss, just like that, and all is done. So we are done with accounting policy. Let's take a look at accounting estimates, and then we go to an example, and then we come and finish up with the rest, that is prior period errors. No worries, we could just do this first. So accounting estimates is just very, very simple and very short, just up to here. We are almost done, so just be patient a bit. Now let's go to accounting estimates. We're on the matter of accounting estimates. I explained this a lot at the beginning, so I hope nothing poses a problem. I explained it a lot at the beginning. As I said, accounting estimate would constitute something. Accounting estimates is when, let's say you need to measure an asset, but to measure an asset, accounting for it requires you maybe to charge depreciation. Now, how do you obtain that depreciation? If that maybe depreciation method has changed, let's say useful life of the asset has changed, things like that. If such things change, we actually have to recompute that depreciation. In a need to recompute that constitute a change in accounting estimate. And as I told you before, we account for it prospectively, not retrospectively. So an accounting estimate is a method adapted by an entity to arrive at estimated amounts. That's our aim, estimated amounts for the financial statements. This is an accounting estimate. That's how to estimate matters. So most figures in the financial statements require some estimation. Of course, a lot of figures would require some estimation. Now, how do you estimate? How do you estimate and say that this is reasonable? I can use it in the statements. When estimating, you have to exercise judgment. Let me tell you one thing. You need to compute depreciation. Depreciation using straight line equals to cost minus residual value over useful life of the asset. If you change the useful life, that means depreciation would also change. So let's say you have changed the useful life. Changing the useful life requires judgment. You cannot just say this asset has a useful life of 10 years, 12 years, 6 years. You have to exercise judgment to arrive at a reasonable conclusion on the true useful life of the asset. So that's why you say the exercise of judgment based on latest information available at the time. Use the latest available information. That's why today you could say that the useful life of the asset is 10 years, but 2 years later you could say it is 12 years, while you expected it to remain at 8 years, but it could be 12 years, the restated useful life. But also, you say at a later date, estimates may have to be revised, as I just told you. That's why we exercise judgment based on the latest information available. That's why you say at a later date, estimates may have to be revised as a result of the availability of new information, let's say more experience or subsequent developments. So it's just like this. Now let's just take a look at changes in accounting estimates and go to just a normal example. So here we are, changes in accounting estimates. How do we account for changes in accounting estimates? We spoke about this very, very early, that the effects of a change in accounting estimates should be included in the statement of profit or loss in the period of change. In the period of change, I told you that changes in accounting estimates are applied prospectively from the current period to the future, while prior period errors and accounting policies are applied retrospectively. So by saying that we apply them in the period of change, we mean prospective accounting. If subsequent periods are affected in those subsequent periods. So it's just like this, account for the current period and subsequent periods, if any. Now here we are told, we spoke about this already, we're just now summarizing. The effects of the change should be included in the same income or expense classification as was used for the original estimate. Just like that. Now this is very clear. It just said that if depreciation was being charged to administration expenses, continue charging it to administration expenses, because if you change that, you would also have made a change to the accounting policies, as we saw above, that a change in presentation, in measurement basis, or recognition, actually sometimes even change of disclosure, would constitute the change in accounting policy. I hope, let me just go back here and tell you one thing. Here, I said that a change in recognition, in presentation, and measurement basis are changes in accounting policy, but also a change in disclosure. I'm repeating again, a change in disclosure too would also constitute the same thing. The change actually, change in disclosure would also constitute a change in accounting policy. Now let's go on, let's just finalize here. I think we're just finalizing here and we have prior period errors and then we would have to solve. So if the effect of the change, so if the effect of the change, if the effect of the change is material, its nature and amount must be disclosed, right? I'm repeating again, if the effect of the change is material, its nature and the amount must be disclosed. If you see something like this effect is material, so we have to explain the nature of the change, but also the amount should be disclosed. Now let's just take a look at examples. Examples of changes in accounting estimates. When something happens like this, you have to know, oh, this is a change in accounting estimate. So just listen carefully here. I just gave you an exam. I just gave you an example here. Before going here, let me go back so as to insist more. I'm just insisting here. The following are changes in accounting policies. Change in recognition. Recognition means instead of debiting an asset, you debit an expense. Oh, instead of debiting an expense, you debit an asset. So if you find something like that, moving from the statement of financial position to profit or loss, or profit or loss to financial position, a change in that is a change in accounting policy. I'm just summarizing here now. That is done. Also, if you see a change in presentation, we are just speaking of, say, line items. For example, I'm in the income statement. I have cost of sales, and then I have, say, administration expenses. You had your depreciation in the previous period being charged to cost of sales, but now they are being charged to administrative expenses. Oh, that is a change in accounting policy. All right, measurement basis. Let's say you had your asset inventory being measured at AVICO method, but now you're using FIFO method. You have changed. That is a change in accounting policy. You would have to go back in the years as much as you can. All right, now let's go to changes in accounting estimate. I need you to know the examples now because these are the main points that I think you have to note. Because apart from just explanations, in an exam, you could be asked these matters. Now you have to note very much these things. The above ones, changes in the presentation, in measurement basis, in actually, I said presentation, measurement basis, but also I spoke of what? Actually changing in disclosures. Or in recognition, things like that are changes in accounting policies. But what about changes in accounting estimates? You go here. Change in the useful life of non-current assets. You know, if the useful life of a non-current asset changes, actually depreciation would also change. So the estimate would change. Here, residual changes in the residual value of non-current assets. This one is very simple. Just define depreciation. Depreciation equals to cost minus residual value over useful life. So a change in useful life is a change in accounting estimate, right? A change in residual value is also a change in accounting what? Estimate. The method of depreciation of non-current assets is also a change in accounting estimate. So this should be very easy for you. You should be able, let's say you are using straight line method and now you're using what? Reducing balance method. You would have to account for it this way. But also, let's say a change in warranty, warranty provisions. If you're just giving a warrant is usually given on estimation basis. You say that, oh, this time I usually provide for a warrant as 10% of what I've sold to customers. Now, if sales have come down to customers, you would also have to set down your warrant, so the warrant would have to change. So a change in warrant provisions based upon more up-to-date information about claims and the claims frequency and value would constitute a change in accounting estimate. So it's just like this. Anything that changes because of the updated information, not because of errors or change in policies, these are actually changes in accounting estimates. Oh, now our time is about to be over. So